Welcome to the 2024 Outlook, a turning point. Senior Wealth Advisor Ryan Trable is going to introduce Mike and the PowerPoint today. Thank you.
Great. Yeah, thank you for joining us today. As you said, I'm Ryan Trable, Senior Wealth Advisor with 360 Financial. Mike Rogers and I will be guiding you through the webinar today. Mike is the president and founder of 360 Financial. Before establishing the firm in 1995, he spent 5 years building a solid financial base with two of the nation's largest investment firms. As a fiduciary, he utilizes his 30-plus years of experience to orchestrate and implement customized strategies specifically tailored to address the issues and concerns of qualified retirement plan trustees, high-level professionals, and thriving business owners. So in today's webinar, we'll be going through research on the economy, stocks, bonds, and policy through LPL's economic forecasts. Throughout the webinar, if you have any questions, you can put them in the chat section or Q&A. And we've also allowed some time at the end to accept additional questions. Also, if you'd like to learn more about 360 Financial and the services we provide to our clients, stick around at the end of the webinar for a few more minutes. Finally, and we would like to know more about you and your thoughts in this webinar. So please take the 1 minute to answer 5 survey questions at the very end as well. So now I'll turn things over to Mike Rogers. Take it away, Mike.
Thanks, Ryan. Thanks for that introduction. I also wanted to introduce Ryan because Ryan is new to 360 Financial. He is a chartered financial analyst. He joined us with 2 decades worth of experience and as a CFA, which by the way, it's very, very difficult to get through the curriculum and pass that exam. He brings a lot of expertise around investment management and wealth planning. So we're happy to have him on the team and look forward to him meeting more and more of our clients and his input on the investment committee meetings that we do every other week. So I'm excited about doing this presentation, and the reason is, and I'm just going to start the screen sharing, is 2023 was an interesting year. So I don't know how many of you watched the 2023 webinar, but I'll give you a recap of it. Okay, we looked at the stock market and we said it looked like it was undervalued for lots of different reasons. Third year of a presidential cycle tends to be good for the market. We had a horrible 2022. We thought there were some opportunities. We even kind of made a prediction, and these are all predictions, that the S&P 500 might be up about 18% for the year based on our math. And sure enough, that's kind of what happened. It actually ended up being a little bit better than that as far as the S&P, which is a basket of 500 stocks. The one thing that was interesting in 2023 about that basket of 500 stocks, especially the first half of the year, it was really driven by 7 stocks. It became known as the Magnificent Seven. It was mostly large U.S.-based technology companies. Microsoft is in there, Apple, Meta, NVIDIA, the semiconductor chip maker. And those few stocks were driving all of the performance returns out of the S&P 500. So you literally had 493 stocks that weren't really contributing very much. So we had that the first half of the year, and then things started trailing off a little bit in the early fall. You might remember your statements might have shown that they had dropped from the end of July time period. And then when nobody expected it, the market started rallying again after the October closing, and November, December were very strong months. So we ended up with a very positive year for the year. Which was what we had hoped for and had expected. What was interesting about that, I saw lots of articles, especially in the Wall Street Journal, that were, that time between Christmas and New Year's, and the headlines were the stock market that nobody predicted or nobody saw coming. It was something along those lines, So when you put the math to it and you put the historical data to it and you look at the longer time frame that we typically have, that short-term time frame looked like something that was going to be positive, and it turned out to be that way. The other thing that we talked about last year at this time was inflation, because it was on everybody's mind, and we were out there again talking about inflation on the downside, where lots of people were talking about inflation on the upside, and it was going to continue for lots of different reasons. We talked about interest rates. We thought interest rates were going to start to drop. We actually didn't really quite get that right. The interest rates started going back up late summer. And part of the reason we had the big ramp up in the stock market the last 2 months of the year is interest rates started dropping. And it wasn't the Federal Reserve cutting rates. That's become very popular to follow now in the news. It's kind of what the bond market was doing. So the very last piece, you might recall a year ago, everybody was predicting a recession. I mean, it was, if you will, fact, that there was going to be a recession. The U.S. economy was going to go into one. It might have been light, it might have been deep. There was all kinds of variations to what that prediction might be. But at the end of the day, it seemed like everybody out there was predicting a recession. And again, we didn't think that the recession was going to come, especially when we looked at the unemployment data. And that proved to be the case. Now everybody's talking about soft landing. So we'll get into that a little bit as well as we go through our discussion today. So I just wanted to recap a little bit on the prediction from last year to kind of set up what we're looking for this year. And the interesting thing about these outlooks and the one here that we have with the LPL Research team called a turning point is these are short-term windows, and at the end of the day, our focus here is a lot more driven around planning, processes, what we can control, what we can't control, instead of these short-term windows. So I like to just, if you don't mind, give me 30 seconds to kind of just review, the way that we typically see the world. And the way we typically see the world is we need to build financial plans and wealth management plans around your goals and what matters to you. All this other stuff that we talk about on our outlooks, it gives you some insight into our thought process and the things that we talk about at the investment committee meetings every other week, or at our wealth management meetings that we hold every week. Because remember, now we have about 20 people on the team. We have specialists in insurance. We have specialists in taxation. We have specialists like Ryan with the investments and the wealth planning part with his CFA and CFPs on the team. So every week we get together and we talk about issues that our clients are facing. And these issues are really built around this acronym of FORM: family, occupation, recreation, and finally the money. Then what we look at is the whys to this discussion and what we're trying to solve for our clients, and use the money as the how to answer some of those questions and address some of those issues. Okay? And so it's a little bit different approach when we customize how money serves as the conduit, if you will, the gas in the engine to drive the other aspects of the life wealth plan. And we know that we have to focus on what we can control. And there's 3 P's of control that we have. We can control our philosophy, we control our planning process, and we can control how we work with you in the process that lays out kind of a plan. And through that plan, we go through 3 steps. It's discover, design, and deploy. And what I want you to just take away as a current client, some of you are not clients right now watching the webinar, is the 360 plan really focuses on this spot in the middle. What matters most to you, what we can control, and then let's put an action strategy and measure outcomes based on that strategy. So again, the longer term perspective on the life wealth plan, I think, is more important to your successful outcomes than our thoughts on a short duration 1-year outlook. But I do like to give these meetings so that you can understand, again, like I said earlier, like our thought process. So let's look at the economy as an example. And Ryan's going to jump in on the stock part of the portfolio. I'll talk about the economy. We do expect that the economy is going to slow down. And so there's a lot of people talking about a soft landing that might occur now. And what we're seeing is there's some downward pressures on CPI, Consumer Price Index, and durables, which are positive things. What we're seeing is that the Federal Reserve, the turning point, if you will, is the Federal Reserve can likely, let me see if I can use my laser pointer on this, can now start focusing on growth of the economy and less on inflation issues around the economy because of this CPI decreasing. Okay. We do believe that a recession in 2024 is more possible than what we saw in 2023. And what we're tracking are things that are leading indicators in the economy, like auto loans and credit card delinquencies, and those have been creeping upward. We also are looking at the savings that consumers have been able to orchestrate, especially through the COVID years, have now depleted those savings. And where is the consumer going to come up with more funds to continue to spend? So part of 2024 is going to be a consumer watch and see if that, if you will, that splurge on spending kind of slows down and it kind of, reverts back to a normal trend that we saw kind of, even before COVID. So we're not predicting a recession. A lot of people say, oh, that's the worst thing that could happen. And at times it could be, but even if we had one, and as we get further into the presentation, we'll talk about, a slower growth economy as being a more likely scenario. The other thing that's interesting is wage growth. So if the consumer is kind of tapping out their spending because they've tapped into most of their savings, can they just switch jobs, increase their income, and therefore continue with their spending? And what we're seeing over here on this right part of this chart is the gap between kind of people who change jobs and get pay raises, or people who stay on their current job and get pay raises. Both of them, as far as the growth rates, are starting to come downward. And part of that is, as the Federal Reserve focuses less on this inflation aspect and more on stable growth in the economy, this actually might help them with that process. We have less people job searching, we have less wage inflation, and therefore they can focus more on how do we keep the economy growing and less on inflation. And so that's an interesting slide there. Another interesting slide when we look at the economy is what happens to the hiring of part-time workers during recessions and maybe leading up to recessions. And so what you'll see here is, again, very volatile chart, but companies tend to hire more part-timers, and this just makes sense during times of uncertainty, and what it gives, if you will, the employer is the opportunity to gauge how's the business environment. Are we going to meet our revenue goals and our earnings goals? And if we need extra help, can we go out to the marketplace and find some part-time help to fill those gaps? And so you can see during recessions, and here's a good example of a deep recession back in 2009, the Great Recession, where part-time help in the hiring of part-timers went up pretty drastically. Okay. And then it just dwindled down over the last 10 years as overall the economy was pretty good. It picked back up in COVID, dropped back down. We had a big labor shortage. We still have very low unemployment, but you can see at least maybe the start of a trend of a little bit more on the upside of hiring part-timers. Okay. And that usually trend is almost a leading indicator or predictor of some recession times coming. The other thing that you want to watch for is the unemployment rate. And again, I talked about this last year, and that's one reason why we didn't think we were going to go into a recession. As unemployment rates are decreasing, we've never gone into a recession. So keep an eye on this coming year. Does unemployment rate start to pick up? And that, I think, will give you another leading indicator of what the economy is going to do, whether it's recessionary or it's slow growth. So The last thing I'll take a look at is, where is there growth in the world? Most of you have money with us know that we have not been a big fan of having money in international investments for a number of years now. That's served us pretty well because the U.S. stock market has performed much better than most of the international markets. And going forward, if we're looking at GDP growth rate here in the U.S. at 1%, Euro is even slower than we are. The emerging markets have the best growth rates, but they also tend to be running hot as far as inflation is concerned. And globally, we're looking at maybe some of these international markets. We haven't made any drastic asset allocation changes in our IQ strategies, but maybe some of these global markets will finally provide some opportunities because they have a little bit better growth rates than they have in the past. The issue with the growth rates is the pros and the cons is one, it's international, so we have to worry about currency fluctuations, which is a discussion for another day, but we also have higher CPI in a lot of these countries. So more inflation. And if those central banks have to increase interest rates, we might not actually see these growth rates because that will slow down their economies. So generally speaking, despite the lower growth rates here in the US, we still favor that area of the marketplace. So with that, a broad, very quick overview of what we talked about last year, and what we talked about, think we're going to have what's going to happen in the economy this year. And then in the middle was a little bit of education on our planning process. So I'm going to hand it over to Ryan as our CFA and let him spend a little time talking about the stock market.
Great. Thank you, Mike. And did a nice job with the overview of the economy in the market as a whole there. So as Mike kind of touched on, 2023 is a tremendous year in the stock market after a really rough year in 2022. So investors are hoping that will continue in 23 and that, continue in 24, and that 23 would be the beginning of a new bull market, a bull market of positive returns going forward, and that the bearish or negative performance of stocks in 2022 was the end of a bear market. So history suggests that in the second year of a bull market is typically a good one. So if you see on this chart here that they show, of the 12 such periods since 1950, the beginning of a bull market, the S&P has gained an average of 12% in year 2 of the bull market, and it's been positive every time. And so that would be good news if we're heading into a new bull market. History has shown that returns have been positive every time. So why is this the case? I thought as I looked at this chart, and I think it has more to do with investor psychology and emotion than anything else. If you look at the periods, these time periods here, starting on the right, year 1 of the bull market, when you look at March of 2020, March of 2009, October of 2002, these are very scary times in the economy. So investors were very nervous. They were kind of expecting bad things going forward after they had seen bad things in the past. So if you go back to the beginning of 22, as Mike stated, almost everyone except for Mike was calling for the U.S. economy to go into a recession, and that this would be bad for stocks in 2022. And typically when almost all investors think things are going to go one way, the market seems to go the other way, and does just the opposite. So we saw leading into 23, investors were afraid of the future, and generally they're getting more conservative and lowering the level of risk they're willing to take. And as the year went on, inflation started to get under control. The economy looked decently strong. Investors started to realize that their worst fears weren't going to play out, and so they rushed back into equities towards the end of the year, and that drove the market up. So getting back to the year 2 of the bull market, which we're thinking in 2024, is investors, going into this, they're seeing huge returns in the first year, being 2023, and this fear of missing out will starts to take over. So the money continues to flow back into the markets as people realize what they missed in 2023, and all the money that was that's still waiting on the sidelines, looking for a rosier forecast, is going to come back into the market because they don't want to miss out on the returns that they saw in 23. And so the current situation could prove even more optimistic, I would say, because there's a lot of money sitting in money market accounts right now. So if you recall, money market accounts are safe, almost like savings accounts, where you could get, investors said, well, if 2023 is going to be a recession, I can get 4 or 5% in a money market account. I'll just stay here. and that looked attractive to them. But now when they compare it to the more recent stock returns, they say, well, let's take that money out of the money market and put it to work in the stock market. And so that's what we see as a positive aspect of the year 2 returns in the bull market and what we think is going to drive returns in 2024. So Mike, you advance the slide here. Okay. So Mike kind of touched on inflation in 2022 forced the Federal Reserve to increase interest rates, and that was a big negative for the stock market. This is negative, as you saw, and investors realized, as we moved into 2023, and investors realized that inflation was going to be getting under control. Interest rates looked like they were stabilized, and even people started talking about rates possibly coming down in the near future. That helped stocks going forward. And so decreasing interest rates can be a good thing for stocks. And this was part of what drove the healthy stock market returns in 2023. But also a positive, I'd say, just for the way we manage portfolios is having negative correlation, which is what it talks about in this slide, and have the phenomenon of where stocks, when bonds do well and stocks are doing poorly, and the opposite as well. That's good, and that's why we diversify portfolios. And so having this negative correlation is a good thing for portfolios going forward. Next slide, please. So this slide just shows historical earnings of the S&P 500. As Mike touched on, S&P 500 is just a grouping or an index, if you will, of the 500 largest companies that are based in the U.S. And so it's kind of a proxy for the stock market that's commonly used. So the LPL's 2024 S&P earnings forecast. So if you kind of took all those 500 companies and aggregate them together, they think that the earnings that they're going to produce is $235 per share. And so when you look at the earnings forecast for 2024 relative to 2023, the earnings are expected to grow about 8%. And curiously enough, too, in 2023, at the end of the year here, they're still reporting here in the first quarter about how companies finished up the year, but the earnings are going to be pretty much flat in 2023. And so comparing to 24 going forward, they're expecting earnings to increase about 8%. Some strategists, this data here that LPL has is at the end of November. And so throughout December, some of these estimates have actually moved up. And a lot of the investment strategists from the large investment firms are now predicting even higher earnings growth of, maybe 8, 10, 11, perhaps growth in 2024. So the takeaway is that the positive earnings growth typically correlates to positive moves in the stock market. So said another way, over long periods of time, longer periods of time, I should say, stock prices tend to move up as earnings go up. So this adds to our positive outlook for stocks in 2024.
The one thing I'll just point out, Ryan, is down here is what LPL did, which is really helpful. They just go out to the street and basically average out kind of what are the different estimates coming in from all the different firms. So to Ryan's point, now a lot of these firms are starting to increase this 235 number. So that is a positive, since there's such a correlation to stock prices to earnings. And and it just makes sense. If a company's making more money, they should be more valuable, and over time they will be. Problem is the stock market's going up and down, and they don't necessarily look at those sort of type of valuations. Who was great at that was Warren Buffett. He used to say, I don't care if the economy is in a recession or where it is, as long as that company keeps growing, I'm fine with it. And the stock market's going to adjust it every single day. But I'm thinking out 5 years or 10 years or 20 years from now, and that's where you create the real wealth. So just an interesting point, to bring up, as Ryan was alluding to. And I think Ryan wants this slide next.
Yep. And so you can kind of take a look at the data here, but essentially what the takeaways from this slide here is that the valuation of the S&P 500. So we see that number, the index value on the news, financial news every day, and the way that number is, they take the earnings, which we just talked about, which is an aggregate of all those 500 companies, and they take an earnings per share of the aggregate, and then basically the market puts a multiple or a valuation on those earnings. And so that's where the number comes from as far as this S&P 500 level. And so for that number or the index valuation to go up, it increases in two ways. We just talked about earnings growth, but also that the valuation or the multiple could also increase. And so we just talked about estimates for 2024 that the S&P 500, the stock market's earnings are going to grow, and somewhere in the 8, 10, 11, those numbers get revised every month. And so it's somewhere in, call it high single digit, maybe low double digits. So the earnings are going to be growing, but also there's the valuation. So earnings growth on its own is going to help push the stock market higher in 2024, because as companies are making more money, as Mike said, they become more valuable. So the contribution from the valuations are going to be a little more limited this year. So stock multiples, and you see on this slide here where it shows the multiple or the valuation on the looking forward earnings, the 235 number, $235 per share number we talked about. So it's in the 18 to 19 times multiple number. And so that is, you don't need to kind of understand all of it, but that is relative to longer term history or averages, that's a little higher than you normally see. Okay, so normal, like a more average multiple on the earnings would be more in the 16 to 17 times earnings range. So the valuation is somewhat elevated this year compared to historical norms. Now that doesn't drive the valuation, surprisingly, doesn't drive the shorter term value or shorter term performance in the stock market. It's the earnings growth is what has the is one of the biggest drivers. The multiple kind of will drive the market can look expensive for long periods of time if you look at a chart of the valuation multiples over time. So it's part of the component about how the market does in any given year, but it's not that big of a driving factor. So stretch valuations is somewhat of a negative data point for the coming year. But if you kind of take all these different things put them in a blender, which is kind of what determines the market. Everyone's looking at different factors to determine what they think the market's going to do. We talked about the second year of the bull market is typically historically been positive for stocks. Like we went through that, there hadn't been a down year in the second year of a bull market. We just talked about, it looks like earnings are projected to grow. And so earnings growing in the high single digits, that would be positive for stocks. Interest rates are stable or coming down, another positive input for stock valuation, for stock performance. And then valuations being a little high, that's maybe a little negative for stocks. But overall, if you kind of, like I said, you put all those things into a blender, you see LPL, they show like a 7.5 is kind of in the market. I should say the market, if you look at the top and they did some of these projections, they did them kind of towards the end of last year at the end of November. And so the stock market has moved up to about 4,750 about right now. So you kind of temper it, but also the estimates for 2024 have also moved up too, along with that. And so a lot of these are just kind of moving numbers a little bit, but if you kind of put all that into a blender, we think that the prospects of having a mid to high single digit return year for stocks overall, it looks pretty reasonable based on what we see looking forward, and also if you kind of look at some of the patterns from history. So do you want to add anything to that, Mike?
The only thing I'll add is we did have a question come in. You answered it. It was talking specifically about the valuations. I opened it up, so I'm not sure if you could see it on the screen or not, but so we addressed that. And so I guess just a reminder, if you have any questions, instead of waiting to the very end, throw them into the Q&A on the Zoom link here, and we'll answer them as we go along. And I'll try not to open it on the presentation screen so that I can monitor it a little bit better, and vice versa. But yeah, you answered that very well. The other thing to keep in mind is this is just an S&P 500 price to earnings ratio. There's lots of other indices, and there's lots of different multiples based on those industries as far as PEs. And there are, in a diversified portfolio, if you have money in small company stocks, mid-sized company stocks, you're going to probably see, or value stocks versus growth stocks, you're going to see some different multiples in there as well. So this is one gauge of the multiples. And a lot of times people talk about the foreign markets as an attractive place to have money because the multiples are lower. And to your point, Ryan, that's one aspect of what we need to consider. But the foreign stocks haven't done as nearly as well over the last number of years as the U.S. stocks, have pretty consistently traded at higher multiples.
Yeah, Mike, and you could say the same thing for small cap stocks. I mean, small cap stocks being smaller company stocks, they typically have more growth opportunities, sort of higher growth, so they have potential to give you higher returns. And then on a valuation standpoint, if you look back in historically, especially relative to larger companies, they haven't looked more attractive in 20 years. And so that's why it hasn't been something that's worked over the last couple of years, because Mike talked about the Magnificent Seven driving returns so much. But that's why we're diversified, where we have some small cap. It hasn't worked last couple of years, but because of the valuation, because of the strength of the economy, we feel like that's somewhere where we should stay rather than trying to just chase what's been working.
I agree. That's a good point. And small companies and mid-sized companies have not kept up with a lot of the large companies, especially on the tech side of things. So hopefully we'll get a little bit better exposure and participation in those areas, like we did in the last kind of two months of 2023. So I don't see any other questions coming in around the stock part of it. So I think I'll just jump into the bond part of it and talk a little bit about that. So again, Ryan, if there's anything that I miss or anything you want to bring up, feel free to jump in. And what I want to do is focus on a couple of different scenarios, and or three, when we start looking at bond forecasts. So I'll tell you, one thing we do anticipate is that interest rates are going to come down in 2024. Just depends on how much they're going to come down. And they're going to come down, we think, just based on what does the economy do. So what I've got labeled here for you are three different scenarios of the economy. And we have a traditional recession. Now, again, we're not in this camp like everybody was a year ago, and a lot less people are in now. But we need to look at that so that you understand the data points. So traditional recession, the economy contracts quite a bit. Inflation declines substantially. The Fed starts cutting interest rates pretty aggressively to try to get the economy to grow. So the lower the economic growth, the more aggressive the Federal Reserve will probably be in decreasing interest rates. Okay, so that's this traditional area. The current 10-year government bond is right about 4%. The current Fed fund rate's about 5.5%. So you can see what we're looking here is a decrease in the short-term rates, a decrease in the 10-year rates, and an overall slowing down of the economy, and maybe a fairly dramatic slowdown in the economy. As we jump into the middle section here, this is where we think we're going to be. But before that, I'll jump into the right side of the part of the screen, and that's, how about if this economy really starts to ramp up, which is a possibility, if you look at kind of what's going on, but the economy growth actually picks up. It doesn't slow down. Inflation starts to increase again. It doesn't decrease like it's been. Now, remember, a little over a year ago, inflation was 9%. Now it's under 4% when we just look at core inflation. So we all know, for example, gas prices have dropped. When you go to the pump, they're cheaper. Have all the food prices come down? Not necessarily, but we've seen a lot of deep decreases in that CPI index. So this environment would start telling us that it's the opposite. We'd start creating this higher demand for goods, and therefore inflation would pick back up. The Federal Reserve has shown they don't have a lot of tolerance for high inflation, so they would start increasing interest rates again and start being more restrictive on their monetary policy. And that would cause an increase in interest rates across the board, okay, which would probably set us up well for this occurring maybe the following year or two. But we think we're going to be right here in the middle, kind of flattish growth, mild potential recession, more likely not, but potentially. The economy is growing, but it's growing very slowly. We had this kind of happening before COVID. COVID threw a fastball to all of us, a curveball to all of us, based on what was going on then. So this is more of the scenario that we had prior to COVID. Inflation expectations start to decrease. They hold steady. We don't see 8% increases in Social Security benefits. We see 2%. That's a gauge of inflation. The Fed starts to cut interest rates because now inflation is under control and they start worrying about the growth of the economy. And so we start seeing short-term rates decreasing. Fed fund rates maybe go down 100 basis points or 1% from about 5.5 to 4.5. So that would be potentially about 4 interest rate cuts by the Federal Reserve sometime this year. We're in the camp of maybe halfway through the year and later that these would start, but there's lots of analysts out there that we respect that are looking for earlier cuts, maybe as soon as March. We think that's a little aggressive, but it's possible. Okay. And then we see that, and I'll jump down here, the 10-year Treasury yield, which is a lot of time what mortgages are based off of, start to see those dropping slightly, not great big drops. But maybe we get down to 3.75, maybe 3.5, depending on how aggressive the Fed is and their short-term rate cuts, which should be good when we go back to the economic slide, should be good for the housing market. If interest rates will start coming down some more, that means mortgage rates will typically follow. And that might mean that it's the affordability of homes increase and for the U.S. consumer. So again, flat, mild growth, slightly contracting, but again, not part of our overall plan, with the Treasury yields impacted by what's going on with the economy. Okay. So the other thing that I like to look at is, when we just look at the 10-year yield, we really do think that we're kind of in this range, if you will, from 3.5 to 5.5%. And historically, that's really closer to 3 to 5, which is kind of this normal range of yield on the 10-year. So if you go back into the 40s, again, a lot of us don't remember this, but this was recession time period. You might have heard from your parents. Interest rates came down. Then we had this huge spike up in rates. And I started in the investment business in 1990. So interest rates were right about here. They were probably about 8 or 9%, roughly. Okay. And I remember talking to people about buying bonds, and they would say, well, why would I buy a bond that's paying me 7% interest when I can put my money in a money market account and earn 8 or 9? Okay. Now I remember this too, this time period, to be frank, now back in 1980, I was in high school and putting my lawn service business money into a money market account and earning 12% on it. And I thought it was the greatest thing ever. And rates started coming down pretty drastically through this, 3 to 4 decade period. And then we had this big pickup. But if we look at this pickup, it's really within normal ranges on this 10-year bond. It's just we got so abnormally low. Part of it was COVID. Part of it was, and therefore mortgages went below 3%. People got used to this being the norm. Well, that's not. This is the norm. And we think we're going to be more in the norm as far as rates are concerned. Okay. And as rates come down, that actually gives us potentially the same sort of opportunities that you would have had when you owned bonds back in the 90s or even the early 2000s, where rates are dropping. And remember, it's a teeter-totter. Those interest rates drop down, the bond prices go up. So your total return between the two is what you actually make. And so we think we're in a pretty good position going forward, instead of parking our money in a money market, which is a good short-term instrument, and it's great for savings or a liability that's coming up, like quarterly tax estimates. But when we're looking at trying to create wealth, this might be a good opportunity to shift some money from those cash holdings towards those bond holdings to lock in some of that higher yield, maybe get a price appreciation in the bond as well. Okay. So the other thing that's interesting, if you look at our bond part of our portfolios right now, and not everybody has bonds in their portfolio. We base it and customize it on the risk assessment, what's appropriate for you, what are your timelines and investment goals. But in the investment area of bonds, what we're seeing is a lot of corporate companies are getting their credit ratings decreased. Okay. And so we see an uptick in downgrades. I know that's confusing, but we're seeing more companies go through kind of a phase where their credit is being decreased. Just like as a consumer, we have lower credit ratings if you're not paying your bills on time, or it looks like your income has dropped. Same thing happens with a corporation. And so currently, the high yield bond market, junk bonds, as they used to be called, look like they could feel a little bit of pressure if this trend continues and companies get downgraded on their credit ratings. And the reason is because it costs more for them to get financing, and therefore that extra cost eats into their earnings. And then it drives down that earnings model and those multiples that we talked about earlier when we were looking at stocks. So overall, we think that there's some good opportunities in bonds. We're not a big fan of high yield bonds. As a matter of fact, in our portfolios, we have 3 different bond funds. One's shorter term in nature. It's a strategic income fund. One is in a corporate bond fund that's intermediate in duration. And then one's a convertible bond fund that can invest into just that, convertible bonds that can convert into common stock potentially somewhere down the road. All 3 different levels of risk, kind of 3 different strategies. But we've been staying away from the high yield, which is where you get your highest return right now, is the high yield still. Okay. More risk, more return. Okay. So Ryan, anything maybe I know you had the stock side, but anything you might want to bring up on the bond piece that I did not mention?
Yeah, no, I mean, I think you covered it really well. I mean, I think the only thing is you've kind of touched on, a lot of people are sitting in money market funds right now, and they're in these shorter duration, like shorter term fixed income, or what happens when, we anticipate that the Federal Reserve will start to lower interest rates going forward. But to take advantage of that, what really works what works more, I should say, as rates come down, is the longer term bonds. And so they benefit from their prices increasing as rates come down, and you don't get that same benefit when you're sitting in a money market fund, because they don't get the same price increases. Actually, their returns just the yield comes down because it's the shorter term rates that come down. But being a little longer in duration and also in higher quality will actually get you a better return than being shorter duration and in lower credit quality.
Mm-hmm. Yeah, good point. I think you reiterated that better than I was trying to communicate. But so we do basically we think that there's some opportunities. The yields are up, so now the yields on bonds are higher, and potentially if that bond's trading at a discount to its par value, you make that up a little bit, some price appreciation. So I think those are big positives on that bond side of the portfolio. So don't believe, again, some headlines is a 60-40 portfolio dead, 60% equities, 40% fixed income or bonds. We don't believe that. Our growth with income strategy is aligns with a 60-40 portfolio, and it's more of a moderate risk strategy that's suitable for a lot of our clients. Not for everybody, because again, we customize it, but it is taking advantage, hopefully, of these interest rates that have now gone up, and we think will start decreasing again. All right, so how about the politics? The one thing, let me just double check here to see if we got any new, questions that came in on the bond side. I don't see anything. Maybe Ryan, you do, or Trony, if you're still on, you can monitor that for me. But politics is always a big thing that pops up at every one of these webinars. Last year, we just talked about, midterm elections were going on, or it just wrapped up, is a better way of putting it. And we looked at the 3rd year of a presidential cycle, and the stock market tends to perform well in that 3rd year. That was another reason why we liked it. fourth year of a presidential cycle, the market tends to perform pretty well also. Not as well as the third term, but usually pretty well. Remember, a lot of these politicians are politicking to get reelected. And so for some reason, the markets kind of believe what they're out there shouting from the rooftops, that they're going to be doing different. But we do know one thing, and Ryan and I were talking about this before we made this presentation, is this political landscape usually just brings more volatility up till fall time. And so we would expect that we're going to get a little more volatility in the markets, especially the stock side of the portfolio, because we do have a November election coming up. And that volatility, if we're right and it occurs, there's going to be a huge amount of negativity around it. The markets are crashing because of X. Fill in whatever you want, in whatever channel you watch. It might be because of Biden, it might be because of Trump. It looks like those two candidates are the ones that are going to square off in November at this point. And so what I just remind clients all the time is, at the end of the day, you know what? Politics really don't play much into the business world. Smart companies like these S&P 500 or these large U.S. companies that we own a lot of in our portfolios, they figure out a way to work within the political structure that's set in front of them for the next 2 or 4 years. And at the end of the day, who controls White House isn't necessarily important to what the markets do. As a matter of fact, I've shown in the past lots of data that shows it's almost irrelevant whether it's a Democrat or a Republican in the White House. And you might say this time is different, Mike, and maybe it is. But I can look at 100 years of data and say it probably isn't. So that's the one message hopefully you take from today. I guess there's going to be a lot of negativity coming. There's going to be lots of commercials. It's going to drive us nuts. It's going to be a lot of finger pointing. From a perspective of looking at your finances, I would say try to ignore it as much of it as you possibly can. Okay. The other thing that looks like might happen, remember I talked at the early part of the segment, there's certain areas we can control or we can't control. Okay. We know for certain at this point, the tax code that was reset a few years ago during the Trump administration sunsets soon next year. Would be the last year of its being around, and that sunsetting changes drastically the tax brackets and, most importantly, to a lot of our clients, the estate tax exemption amount. So that's the sort of thing that we're looking at when it comes to elections. So if Congress goes Republican or Democrat, how much impact is that going to have on these? Potentially on these tax codes, if the Senate goes one way or the other, so it almost looks like this election is going to be really focused on for us, potential tax policy changes. And so we just have to make sure that we're talking to you about that and we're very prepared for that to occur, because it could be pretty dramatic for a lot of people if you go into it not planning accordingly. Obviously, there's a lot of turmoil going on globally. If you look at what's going on in Gaza between Hamas and Israel and the war that's occurring there currently and how that impacts the global markets, you'll see that generally it has not yet. I know there's going to be more news of that, headline news of that potentially spreading throughout the Mideast. We haven't seen that yet. But that will bring volatility potentially, as well as the Russian-Ukraine war brought especially initial volatility when Russia first invaded, that territory coming up on, a couple of years now, next month. And so we had an interesting perspective here, that we welcomed an individual from the Ukraine this past fall. And he's a missionary worker in Ukraine, and his story was was compelling, to say the least. It was emotional. It was talking about he and his wife and his brand new baby's experience of how their work as missionaries had shifted drastically from helping the youth in Ukraine to feeding the people who are being devastated by this war effort. And it was eye-opening, to say the least. And it brought this news story down to a level where we could understand it better from a human side of the story. And I think those are more important stories than a lot of the headline news that you see about what potentially could happen in these different conflicts and how it could impact either the global markets or here in the US. So from a political perspective, it is complicated. We have this really decisive nature, especially here in the US, regarding the political parties and even the two candidates that might be sitting in the White House next year at this time. But I do want to address that fear of the unknown is what the media loves to get you to click on, get you to buy, get you to watch, and take it all with a grain of salt would be my approach and my recommendation to each of you on this webcast. So with that, unless Ryan, there's something I missed. I'm not trying to lecture people on behavior and what to watch for and not watch for, but I do think it's important that they understand kind of where we're coming from as far as these political aspects and how they impact our strategies. And we just don't think they do most of the time at the end of the day. Okay. So finally, as we wrap it up here, there's going to be a little segment for you who are brand new to the 360 financial community. If you want to listen more about how we work with clients and what it looks like to be a client, stick around. We'll go through that a little bit on a high level for you. For all of our clients, I mentioned the word community. We look at 360 as a membership, and you're all members of this community. And that means that each of you as members have the ability to access anytime you want for any questions that you have. And we'll get back to you in a timely manner. It also means that you have the ability to use what we call our sounding board strategy. So if you have people that are asking questions, these are friends or family members that are important to you, they can always reach out to us. We know most of them do not need our services. They won't be a good fit for what we do, but that's okay. We don't care. If we can help somebody that's important to you, then they become important to us, and we can give them the right guidance and some direction. If they become a client because there's a good fit, that's great. But if they don't, and we can just help them, that's the most important aspect of this sounding board. So everyone in the community gets this sounding board approach. And we've had kids that are in college call us about student debt loans. We've had kids that are getting out of college talking about how they should invest into their 401k plans. We've had adult children that are trying to figure out, should they lease or buy a car, or should they buy a new house? Those are all questions that we're pretty well positioned with our team here of specialists to help answer. So I don't want you to forget about that availability of what we call our sounding board. So with that, I think we really have answered some of the questions that have come in. I think maybe all of them. And as we go along, I've noticed that some of the questions we've answered. So that's good. We kind of predicted what some of the questioning might be, and we've been able to help with that. So of course we have disclosures that we always have to show, and disclosures around interest rates and bond prices will fluctuate. Stock prices go up and down. Anything that we said here today is our opinions and our thought process. And of course, past performance is no guarantee of any sort of future results. So we have to just go through that as part of our overall webinar. There's some definitions. Troni is going to send out to everybody, whether you attended or were unable to attend, even though you registered, this recording, so that everybody can diligently study those disclosures and get back to us with any questions that they might have. So is there at this point, Trony, anything that you think, I'll go back one slide here, anything else that we need to cover for our current clients and the people who would like to stick around a little bit longer to revisit the process here at 360?
Yeah, so I just want to say thank you all for your time today. Again, we will be emailing out this recording of the webinar. Keep posted for additional webinars coming in 2024. And at this point, we will shift into those. For those who are new to 360, Mike will start explaining a little bit more about 360 and who we are and how we work.
Thanks, Trony. The one thing I'll point out, it's there's now a little bit of snow on the ground. A lot of our clients have gone south for the winter, at least for temporarily or maybe for the entire winter. So the question around, should I change my residency to a different state, tends to pop up around this time of the year. We did a program just about a month ago that went through all of those hurdles that you have to jump over if that's something that you might be considering. So if that's something that interests you and you weren't able to make that webinar or you didn't know about it, let us know. We can send that out to you. I thought it was really good information.